All right, folks, you want to find out where to invest. Do not buy a particular industry in a particular country when investing internationally. Sector investing can be very tricky. Make sure you allocate to all major sectors. According to financial advisors, you should have a proportionate investment in each sector. You will need to invest in a lot of different ETFs if you follow sector approach. If funds are going to copy each other, there is no point having a lot of funds. If you invest in individual funds and do not want your dividends money right away, you should have an account that will automatically reinvest your dividends, and make sure your brokerage does not charge you commissions for reinvesting dividends. You should always keep a portion of your investment in bonds. Most bond ETFs are inexpensive, transparent, and highly liquid. Bond ETFs can produce cash in form of interest payments. Bonds are usually less volatile than stocks, and their return is less. Over the past 80 years, the average annualized return of S&P has been around 9.9%, while the return of long-term US government bonds has been approximately 5.5%. When buying a high-yield bond ETF, keep in mind, if the economy goes bad and shaky, shaky companies start to sink, you will lose both the income from bonds and the principal. If you're holding a bond with a 5% coupon rate and prevailing rate jumps to 10% and you hold the bond to maturity, there is a great opportunity cost. However, if the interest rate drops to 3%, your bond will suddenly become a hot ticket that you can sell at a heavy premium. Interest rates and bond prices have an inverse relationship. When interest rates fall, already issued bonds carrying high coupon rates shoot up in price. Adding bonds to your portfolio will give you diversification. You can add corporate bonds, international bonds, and municipal bonds to your portfolio. Bond funds will make your bond investing easy and keep your costs low. Bond funds have an added advantage of reinvesting your interest payments. Treasury bond ETFs come in short-term, intermediate-term, and long-term varieties depending on the average maturity date of the bond in the ETF's portfolio. In general, the longer the term, the higher the interest rate, but greater the volatility. Assuming that you are of an average wealth, you're going to retire at an average age, will live average life expectancy, and expect that the markets will see roughly average performance, there is a rough rule that says you should subtract your age from 110, and that is what you should have in stocks, and the rest should be in bonds. Real estate investment trusts are very popular, and they are known as REITs. They are companies that hold portfolios of properties such as shopping malls, office buildings, hotels, amusement parks, timber, land, or they may hold certain real estate related assets such as commercial mortgages. REITs typically deliver annual dividend yields significantly higher than even the highest dividend paying non-REIT stocks, and twice that of the average stock. REITs are required by law to pay out 90% of their income as dividend to shareholders. Because REITs do not have to pay income taxes, their dividends are usually fully taxable to shareholders as ordinary income. Your primary motivation to buy REITs should be diversification and potential growth. REITs have offered a very good diversification in the past. The REIT allotment you give to your portfolio can be evenly split between local and international REITs on 50-50 basis. You can get a list of REIT funds by going to www.reit.com. Click on Individual Investors, then List of REIT funds, and then Exchange Traded Funds. Keep your gold ETFs in a tax-advantaged account, or otherwise you can get hit hard when you sell. Your portfolio should not have more than 5% in precious metals. GLTR is an ETF that was introduced in October 2010. In this fund, you get precious metals like gold, silver, platinum, and palladium. Folks, this presentation is for educational purposes only. It does not constitute any legal advice or opinion of any kind. Please do not use any of its contents without seeking a professional advice. All information contained in this presentation comes from the book Exchange Traded Funds for Dummies. It's written by Russell Wild, who is a NAPFA registered financial advisor. My name is Mansoor Suhail Mani. I'm an accountant operating out of Scarborough, Ontario. You have any questions? Feel free to give me a call or email me. Thank you for listening and hope you enjoyed this presentation. Thank you.